Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. Here's your weekly technical analysis of Chicago wheat and corn. I'll start with Chicago wheat. There was, when I last spoke, a single major pattern left that was driving this market higher. It was the July to September bullish shift pitchfork. We'd seen the market channeling higher in between the lower time, currently at 785, and the middle time, currently 855. Then break up over the middle time, but stall at resistance formed originally back in July to November 2012 between 860 and 883, before making a significant combined daily key reversal down, that is, and bearish engulfing pattern, if only just on the latter. This all happened 3 weeks ago. And since then, prices dropped down through the middle time. And then this week, specifically on Wednesday, the market constructed a combined bearish opening long black Marubozu and a bearish engulfing pattern that punched down through some very key levels. These were the short medium moving average, currently at 789, the August high at 786, the April and May highs at 769 and 767 respectively, and the important rising medium moving average, currently at 761. Interestingly, prices could not maintain themselves below the medium moving average, as we ended up closing back up over that moving average. However, this was the only bright spot out there for the bulls, as otherwise, admittedly, with yesterday's immediate countering bullish harami, the market still made a second consecutive close below the key bullish shift pitchfork that has driven this market higher since early September. Thus, after this commentary, this pitchfork will be retired. It is interesting how the market maintained itself above the medium moving average, as below that there was no support until the May 2014 high at 744. And perhaps as this did not appear to be that strong a support, then the 50% Fibonacci level below that for the whole of the 2021 action at 733 would have been it. Nevertheless, it still does not look that good right now for the bulls, as since late November this market has had a tendency to make 3 steps down and 1 step up, and we are now in the 1 step up phase with a lot of previous support above that have now become resistances. How well this medium moving average holds up the market is now key. Chicago corn. One of the possible scenarios I reiterated last time, I had originally mentioned some 7 weeks before actually, and I quote, "On top of all this, there is one other option that made itself available. It was to look at the July to date action as a possible descending wedge pattern. There is merit in this, with the lower trend line well below, and that's actually currently at 461, and this week's move up, remember this is now 7 weeks ago, being a break upwards and away from either the descending triangle or the descending wedge pattern." Now these two patterns I've mentioned were over the summertime, and I've detailed them enough already. However, I should point out that the upper trend line of both these patterns, which is currently at 498, also make up the upper trend line of this falling wedge pattern. I added to these comments 4 weeks ago thus, and I quote, "I gave some thoughts on potential targets for the descending wedge pattern. Well, unsurprisingly, the initial potential target for this pattern ties in with target X3 at 605. However, the secondary target for this pattern is lower. Target X5 for this pattern is in the 626 area." End of quote. So these are the targets above for this large descending wedge pattern. However, even back then, I found some issues with the move higher, with the market exhibiting a lot of indecisive daily patterns. That being said, I also back then focused on what I saw was a key support. Again, I quote from 4 weeks ago. Yet I still suspect the long moving average below, which is currently at 569, may be the core of recent support. I'm still not sure if we will break higher or drop to test the congestion around the medium and short medium moving average, currently at 568, the short medium is. To be honest, I would like to see some more action to help clear this up. I think I'll leave it there and watch to see if the recent moves higher turns out to be a true or false. Well, since then we can easily see that the long moving average has indeed been the core of the support. It was tested twice in November and held up well both times. Additionally, the short medium moving average has now moved higher and is now adding its muscle into the long moving average. Therefore, what we have ended up with is a very shallow bull channel, currently 567 to 600. Since the start, and that's since the start of November. This slowly rising bull channel is motivated by the slowly rising long moving average. That is where we are now and what is actually driving the market. We're now very close to target X3 and also close actually still to the long moving average. And it will be interesting to see which will be reached first. At this moment, it looks like target X3 seems to be the more likely. However, just keep an eye on whether the market will still stay or not within the bull channel. That could well be the key to the next major move. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.